Hi there, it's Mike Kramer of Mott Capital. Today is Tuesday, April 23rd, and it's around 7 p.m. New York time. So the rest of the week, we're going to start seeing things really ramp up, specifically on Thursday morning when we get the GDP numbers for the first quarter. Estimates are for a 2.5% quarter over quarter seasonally adjusted annualized rate. The personal consumption seen coming in at 3%. GDP price index seen rising by 3%. Core PCE index quarter over quarter up 3.4%, a big jump from last month quarter's reading of 2%. This isn't to be confused with the numbers we'll be getting on Friday, which is the PCE month over month for the month of March. That's expected to rise by 0.3%, up flat from last month. PCE deflator year over year up 2.6% versus 2.5%. Core PCE expected to rise by 0.3% in line with last month. Core PCE year over year expected to rise by 2.7% versus last month's 2.8%. And then, of course, on at 10 a.m. on Friday, we'll be getting University of Michigan. We're going to want to watch the 1-year inflation expectations and the 5 to 10-year inflation expectations because those came in hotter than expected in the preliminary reading, and we're going to want to see what they come in for this month. And then, of course, we're going to start getting a lot of data coming in next week as well, which is worth reviewing. On the 30th, we're going to get the employment cost index. This is a very big number that the Fed watches. That will be on the 30th. Then also, by the time we get to May 1st, we're looking for ADP, 190,000. We're looking for JOLTS, and we're looking for ISM manufacturing. ISM prices paid, obviously a big number. And of course, the FOMC meeting is later in the day on May 1st. Also this week in Japan, we're going to be getting a BOJ rate decision along with a forecast coming on the 26th. So there's a lot of stuff going on between now and the end of this week and the middle of next week. So there's a good reason not to get complacent at this point, especially with what we're sort of seeing taking place in the markets overall. We've seen a pretty good snapback rally in rate in the market over the last couple of days on the equity market, and mostly that's because we've seen things like the 2-year rate really sort of stall out at this point. And as we've sort of been talking about now for some time, the 2-year really just continues to consolidate at this point, and it has what looks like to be a bull flag that's formed in it. This bull flag would suggest we could probably continue to move higher, maybe 5.25% on the high side, 5.15% maybe on the lower side. Certainly when we continue to kind of look at the patterns that are here, you could make a case that there's also a cup with handle that's formed in the pattern, which is broken out as well. And this would certainly, again, also indicate that we could see the 2-year rate moving higher, maybe to 5.35% on the high side and around 5.1% on the more conservative side of the equation. So what they're both of these patterns are sort of suggesting at this point is that it's likely we continue to see the 2-year rate moving higher. And certainly if we get economic data that's supportive of rates moving higher, we're probably on the very close here to seeing a big move up in rates on the 2-year. On the 10-year, it's a similar sort of look. Right now, we're sort of just consolidating in this zone around 465. You can see that once you get past 465, there's just not much resistance, if any resistance at all, really from stopping the 10-year getting to around 495 or so. Clearly, the 10-year has broken out. It rose above that 435 level that we had been watching and really moved very quickly up to 465. And so at this point, at least, 10-year is no longer overbought, and there's certainly room to rise just based off of this Bollinger Band to around 475 or so before we would see it really sort of potentially find another resistance zone. When we look at the dollar index, that's also been kind of stalling out more recently. Again, this is a big area of resistance for the dollar, with the key really coming at this 107 area. Again, it depends on how you want to really look at things. You can make a case that there's a double bottom forming, with the beat neckline being in this region, which could result in the dollar index perhaps breaking out and moving up to around 113. That would certainly be an area of resistance as well. You can see that basically once you get past 106 or so, 107, there's a clear line rally to the to that level. Certainly, we can also make a case that perhaps there's a diamond bottom that formed in the dollar index, and now we're basically in the process of that diamond bottom breaking out. And we're likely to see the dollar continue to strengthen, not just against the broad basket, but also against things like the euro. We've seen the euro sort of see a little bit of a move back up in recent days, again, kind of coming off of oversold conditions. I would be looking for resistance at the 20-day moving average. Ultimately, again, as we've discussed in the past, it looks like the euro is probably heading back to lower levels, given that you're seeing, Fed policy really diverging from policy out of the ECB. A lot of officials out of the ECB are talking about, multiple rate cuts this year. And so it seems likely that we could see, if we were to see the euro break below this level here at 104.5, we could be setting up for something steeper. So right now, again, I think the 20-day moving average is sort of an area where you could find resistance, with the next area of resistance around 108. Otherwise, it looks like the trend is still lower for the euro. We also had a pretty good move in the pound today. The pound was also very close to being oversold. Basically, you saw the RSI down below 30. You saw it on the lower Bollinger Band. So again, you can look for resistance at the 20-day moving average here around 125.25. But ultimately speaking, again, the pound also looks like it's a position of overall weakness, just because, again, we have monetary policy that's sort of diverging at this point. This would be your overall big support level at 120, with a break of support at 120, setting up a move to 118. There's still plenty of room to get there. But again, ultimately speaking, if the data in the U.S. is going to be supportive of a stronger U.S. dollar, then one would expect to see the pound continue to weaken. Also, we've seen the Japanese yen really see a meaningful breakout. Now, it's not expected that they're going to raise rates at this meeting, although there's been some rumors and talk about possibly the BOJ discussing the weakness we've been seeing in the yen more recently. But overall, what looks to me like we've seen the yen actually break out, and could continue to rise as long as we continue to see rates in the U.S. moving higher. Because again, what's largely driven a lot of these moves that we've seen in rates over the last couple of weeks and months has really been interest rate differentials. And so if rates in the U.S. start moving higher again, then it seems possible that you could really start seeing the yen really weakening versus the dollar. And you can see what looks like maybe an inverse head and shoulders pattern, which is formed. And so if we were to really kind of take this to the next level here, if this is an actual inverse head and shoulders pattern, we could be looking for the spread to widen out to around 415, and that would certainly be enough to continue to push the yen to even higher levels. With that said, if we take a look at the DAX actually had a very strong day today. It was its first really solid showing in a couple of weeks. We did break at least this downtrend for the moment. It really kind of raises the question whether or not we're seeing some sort of bull flag forming in the DAX, which certainly could mean that the DAX has much further to climb here. And it's kind of early to say that for certain. But again, what we've kind of seen was a DAX that had gotten to an oversold level on the Bollinger Band. And right now we're at the 20-day moving average. So the way I would think about this is that obviously if we get above the 20-day moving average, then there's probably room to rise to the upper Bollinger Band at 18,605, which is roughly in line with the previous high. And then if we were to get above this high, it would kind of confirm this idea that perhaps, yes, this is a bull flag, and the DAX is actually still continuing higher with a target range of probably around 19,318. But again, if we were to fail at this 20-day moving average, come back below, break below this trend line, that would probably be an indication of it not being a bull flag, obviously, and suggestive of a market that probably continues to head lower. The FTSE actually hit a new all-time high just recently. And so, again, what we're sort of looking at here is a market that's after after a really long period of sideways consolidation and really struggling to make a move higher, we finally saw the FTSE break out. Again, we're not significantly overbought. We can still probably see the RSI move higher, although you can see we did have a little bit of a reversal off of the 20-day, off of the upper Bollinger Band. So at this point, again, it wouldn't be surprising to see some consolidation around these levels, just because when you typically get to an old high, you typically consolidate around it, test that for a couple of days. I would be looking for support at the 20-day moving average. You can see that that's held as support on several occasions. So right now, it just seems like we have to kind of give this a little time to see how it works out. The S&P 500 has seen a rebound the last couple of days. It did get nearly oversold, getting to around the 31 RSI and coming through the lower Bollinger Band. The most obvious spot for a retracement, at least on the interim, is probably at the 20-day moving average around 51.40 or so. But again, this is largely going to be dependent upon where interest rates are going, because if interest rates start rising again in the U.S., you're going to see equity markets begin to turn lower again. So when we move over to the NASDAQ, it's also a similar look, again, getting very oversold. So it's not really all that surprising to see that we're getting this snapback rally. In fact, you were trading below the lower Bollinger Band. You reached an RSI of 30. So again, the most natural place to sort of gravitate back towards in this case would be the 20-day moving average around 17,898. The question is just whether or not you can get there fast enough, because if the GDP data should come in hotter than expected and rates start moving and the dollars kind of start moving as we think, then the rally may not even make it that far. So you're looking at maybe 17,785 as one spot, and then maybe 17,900. The Dow has actually been more productive the last couple of days. You can actually see the RSI has started to turn higher, and the Dow sort of bottomed a few days prior to the S&P and the NASDAQ, and you can already see the Dow maybe telling us which way the NASDAQ and the S&P are going, getting back to that 20-day moving average. So again, if you get above the 20-day, you probably have room to maybe start thinking about filling gaps up to 39,500 or so, with maybe even a potential move to 40,000 on the upper Bollinger Band. If we fail here, then that's really going to be telling you a lot about what's going to happen, because probably the next thing that we see is a move back to the lower Bollinger Band and an undercut of this level at 37,730. So anyway, that's all we have for today. We'll check in again next week. Until then, have a good one. Bye.